A very good morning, friends. So I think it's a start of the new year, and what a good way to start that we are starting with our studies early in the morning. I think it's a good omen. So first of all, I take the opportunity to wish you all and your family members a very happy new year. May this new year bring a lot of joy, happiness, and the prefix chartered accountant in front of your name. Okay, so I guess let's start back on the journey. So we were discussing the block number 2 on Index 110, where we were discussing the concept of consolidation procedures. And I had done 2 cases with you so far, wherein I had covered the consolidation. Number 1, when there was no NCI, but consolidation was done on acquisition date. The second one which I did was a consolidation again on the acquisition date, but there was an NCI. So we've done 2 cases when the consolidation is done on the acquisition date with or without NCI, to put it very clear. Now I'm going to go that consolidation is an yearly process. So we're going to move to the case where the consolidation is done later, a second year, third year, whatever, and there is NCI or there is no NCI. So the basic broad picture which I'm setting at the back of your mind is consolidation on acquisition date with without NCI, consolidation later with without NCI. Now, once these 4 cases are done, we will be, more close to creating a 7-step model. And we'll do a lot of questions also on that area to get complete expertise on the consolidation process. Right now, we're working on a consolidated balance sheet. We'll very soon come to the concept of consolidated income statement as well. So let me now take you, I'm not creating a summary chart because we yet not done too many consolidation. I'm directly coming to my case number 3, or you can say situation 3. So we are talking in terms of consolidation procedures. So in terms of the consolidation procedures, I'm looking at a case number 3. So I'll make a few changes in the case number 1, which I gave you, and make some changes out here. Now, what are the key features in terms of case 3? I'm considering that you are doing a consolidation, let's say 1 year later. So we're going to make a consolidated balance sheet 1 year later. But let's consider there is no NCI. So I think I'll need a little help from your side. I need the figures which I gave you for the parent company and the subsidiary company on the date of acquisition so that I can create my consolidated balance sheet. Or let me just, create a little more space. So let's say this is the balance sheet of the parent company which I gave you, and this is the balance sheet of the subsidiary. And let's take this as a consolidated balance sheet. So I think I'll need a little support if you can keep giving me the figures. So I gave you the balance sheet of the holding company that was on December X1. Now I'm giving you a balance sheet on December X2, 1 year later. So I'll make some changes in the assets and liability. So if you can tell me what was the NCA and the investments and the current assets. If I vaguely remember, I think it was 500, 300, 200, if I vaguely correctly remember.
Yes, sir.
Great. So I think I'll just make this as 600. Investments would remain the same. And current assets also slightly made a change. What was the equity share capital?
200.
Great. And other equity, I think, was 700, I guess.
Yes, sir.
Great. And the current liabilities, I think, was 100. So I'll
Yes,
take it
sir.
as 150. So let me see what is the balancing figure in the other equity. This would indicate the profits earned during the year. So let me just take the balancing figure. This is coming to 850. So this 150 represents the profits earned during the period of 1 year. That's the change in the balance sheet, trying to maintain the same flow of thought. Let's go to the subsidiary company's balance sheet on December X2. And what was the non-current assets and the current assets?
200 and 100, sir.
So I'll make it as 250 and let's say 150. Equity share capital, I'll keep it the same. I think it was 100 if I rightly remember.
Yes, sir.
And current liabilities, I think was how much?
50.
50. So I'll take it as 100. And my other equity, I think was 200, I guess.
150, sir.
150. So I'll take this as a balancing figure so that we can get what is the profit for the year. This is 200. So this becomes 50 profit for the year. Perfect. Okay. Now watch this carefully. I've given you a balance sheet of the parent, the holding, and the subsidiary 1 year later. I've kept the investment same. I've kept the equity share capital same. The rest all is similar. So I want to make my consolidated balance sheet on December X2, 1 year post the acquisition. Mind the words, 1 year post the acquisition. Now, let me ask you again. Will the goodwill which you identified in case 1, would that remain the same? What you identified a goodwill on December X1, would that remain the same on December X2 as well?
Yes.
Yes, because goodwill is not amortized under Ind AS. Goodwill is impaired under Ind AS, and if I presume that there is no goodwill impairment, it would remain the same. I'm very clear on my thoughts. So as far as goodwill is concerned, I am giving the assumption it is assumed that there is no impairment loss. And if there is no impairment loss, my goodwill will remain exactly the same. So how much was the goodwill? I guess 50?
Yes, sir.
Wonderful indeed. Now watch me carefully. Please watch this carefully because we're going to develop a logic in terms of doing this consolidation. Can I make a statement? This goodwill considers the equity share capital. This 150 equity vis-a-vis the investment, correct?
Yes, sir.
We compared this 300 versus the total of this 250, and that's how we get the goodwill. And we decided that once you've taken the net impact of these figures, these three figures cannot appear in the consolidated balance sheet. But would this 50 appear in the balance sheet? Yes or no?
Yes. Yes.
Absolutely makes mathematical sense. You know what we said in a consolidated balance sheet is just add the two balance sheet. So in this particular case, this goodwill is the net impact of this 300 as well as this 250. So you've taken a net figure of 50, but this increase is nowhere taken in the goodwill calculation. I would technically call this as a post-acquisition profits. The profits which is earned after the date of acquisition. So this 50 can be technically called as post-acquisition profits. The subsidiary company has earned these profits after the date of acquisition. Well, let's understand this logically. Can I say as a parent company, sorry, can I say as a parent company, I am 100% stakeholder of that company? Because I have all the shares of the subsidiary company, so I am the only shareholder of this company, which means that all the profits earned belongs to me. So as a parent company, what will I do in the consolidated balance sheet? When I take this other equity, I will consider my own equity, that is 850, and to this we will add this post-acquisition earnings. Because after the date of acquisition, all the profits earned by the subsidiary company belongs to me as a group. Let's say, for example, if I've got 80% stake, I would have taken 80% of this. So we need to very carefully go with the funda that this profits earned by the subsidiary company belongs to the parent company, so he adds it to its own other equity. Trust me, rest everything is exactly the same. I'll aggregate assets to assets. I'll aggregate liabilities to liability. My consolidation is done. The only change, the only change which you can see in situation number 3 is adding the post-acquisition earnings in the other equity. Let's now add the other inputs. Add the non-current assets 1-to-1. So if you add this 600 plus 250, that makes it 850. Add the current assets 300 plus 150, that makes it 450. 1-to-1 line-to-line addition is what we're going to do in terms of consolidation. Equity share capital will be for the parent company only. That's 200. Other equity we've already considered. And we can add the current liabilities 250. Let's see, is the balance sheet agreed on this or not? See, 1350, and I guess 1350 is the balance sheet tallied, I guess.
Yes, sir.
Perfect. So this gives me the consolidated balance sheet, which is 1 year later. Now, let me say a few things at this stage, which you can easily vouch me. What you can see, observe in the consolidation, I'm just going to put that in words, vouch me very carefully. No worries, we'll document all this later. Number one, can I say investment in subsidiary never appears in the console? I'm putting very clear and clear-cut words. Investment in the subsidiary never appears in the console. Is that a correct observation?
Yes, sir.
Wonderful indeed. Number two, can I say equity share capital of the subsidiary never appears in the console?
Yes, sir.
That's correct observation again. Number three, can I say pre-acquisition other equity? Mind the words what I said, pre-acquisition other equity. The other equity is total 200, but I'm making a reference to pre-acquisition, the equity which is there before the date of acquisition. The pre-acquisition other equity of subsidiary never appears in the console. The post appears in the console. Correct?
Yes, sir.
So 3 observations I've done, which tells me what does not appear in the console. Investment does not appear in the console. Share capital of the subsidiary doesn't appear in the console. Other equity pre-acquisition does not appear in the console. Now, 2 observations which will appear in the console. Can I say goodwill and in other cases, NCI appears as a separate line item in the console? Correct?
Yes, sir.
That's right. And the next 5th observation is assets and liabilities are aggregated 100% irrespective your percentage of stake is 80 or 100. I will always aggregate 100% assets and liability because the technique of consolidation is called a full consolidation. So I'll end up consolidating all the assets and all the liabilities 100%. Got my point, I guess. 5 golden rules of consolidation. Don't worry, I'll pen them down later. But I'm just trying to look at the observations in terms of consolidation, where I'm saying 3 things not to appear and 2 things which are going to appear. So just keep in mind the 3 things which will not appear in the console is investment, share capital, equity share capital of the subsidiary, and a pre-acquisition other equity. 2 things which are going to appear in the console, and that is number 1, goodwill NCI appears as a separate line item, and you can say aggregation of assets and liability 100% irrespective of the percentage. I hope I stand clear on my thoughts.
Yes, sir.
Wonderful indeed. So let's do one thing. Let's do another case as well, which will consolidate all the inputs in one go. So I'm now going to the case number 4. Which is an extension of case 2. I'm going to make a consolidated balance sheet 1 year later. And I'm going to introduce NCI as well. So this is an extension of the case number 2. So whatever balance sheet I gave you in case 2, I'm just going to make slight changes in that balance sheet. So I'll just make some slight changes in the balance sheet. Let me just take the balance sheet of the parent and the subsidiary, and we'll make the consolidated balance sheet. Try to apply these 5 rules which I gave you. So this is the holding company's balance sheet on December X2. This is the subsidiary company's balance sheet on December X2. And I want to make a consolidated balance sheet on December X2, which is 1 year later. Just to remind you, holding in subsidiary acquired 80% stake, and that was acquired on December X1. That was the case number 2, which I did, and we're doing an extension of the case number 2, 80% stake, and the acquisition date December X1. So I think I had given some few changes in the balance sheet. The NCA, I kept it same in the second case. So I'll just probably take the NCA 600 and current assets as 300. 600 investments will become 240. I think the investment was 240, right? In the case number 2, correct? And then let's take the equity share capital, the other equity, and the current liabilities. Equity share capital, let's take it 200, and the current liabilities is 150. So this is, I guess, going to be 850 itself. The profits earned during this year is 150. I think the balance sheet is agreed on this. Yes. And subsidiary balance sheet, I think I'll take it same, 250 and 150. The non-current assets is 250. The current assets is 150. Equity share capital is 100 and the other equity is 200. And we've got the current liabilities also as 100. And the breakup of this is 150 plus 50. So the balance sheet which I've taken for the subsidy is exactly the case number 3. But in holding, I just made a slight change because we acquired 80% shares. So I've taken the investments from the case number 2. Okay. Now you are going to help me out in this case. Is the goodwill going to remain the same which we did in case 2? Or will it undergo a change? The case 2 where we got 80% stake.
It will be at PSNA.
Would it remain the same or will it change?
Same.
It'll remain same. If I assume there is no impairment, no change. So what was the goodwill in case 2? Assume no
Okay.
impairment.
2.
That was how much?
40. 40.
40. Great. So goodwill is 40. Now let's watch this carefully. Is this goodwill taken the investments into account? Yes. Is it taken the entire equity share capital and the pre-acquisition equity? Yes or no? Is it taken the entire equity share capital and entire pre-acquisition equity or 80%?
Full, entire.
No.
80%.
I took 240 and I compared this with 250 into 80%.
Yes, correct.
So which means the goodwill considered 80% of the equity. So 20% will appear in the balance sheet. Yes or no?
Yes.
And that would appear, as I said earlier, as NCI. So 250 into 20%, that is 50. Okay, now I'm going to ask a question. If this is clear, you're sorted. This is the post-acquisition profits as we mentioned in the previous case as well. So now tell me, is this entire 50 going to go to the parent or will it be divided in the ratio of 80-20?
Divide.
That makes sense because this profit is now 80% to the parent and 20% to the NCI. So unlike the previous case, what I did, I took this entire as a part of other equity. But in this case, we will take 80% here and we will take 20% in the NCI. That's the only change. So this makes it 60. Trust me, rest of the consolidation is absolutely similar. We'll just add up the assets and liabilities in this case. So non-current assets is 850. We can add up the current assets, that is 510. And the equity share capital of the parent company, that is 200. And we can take the sum total of the current liabilities, that's 250. Let's see if the balance sheet is agreed on this or not. Should agree actually. So this is, I guess, 510, 40, 850, 1400. Yes, the balance sheet is perfectly tallied on this. Wow. Now this is too simple, but it's a little disorganized if you ask me. But I think if you've understood all the four cases, trust me, I am now going to give you a 7-step model based on the observations of all these four cases. Any concerns at this stage on the four cases, you can ask me. Otherwise, I'm going to use this as a base to give you a 7-step model. All good to go? Or any questions on your mind?
All good, sir.
Okay, wonderful indeed. So let's now consolidate the entire picture. And I'm going to, consider all these observations in four cases, creating a 7-step model. I insist that when you're going to do questions in the exams on consolidation, irrespective of the intensity of the question, go with a step-by-step approach. You'll never ever go wrong. So let's do one thing. Let's develop the 7-step model. Let's develop the 7-step model in terms of making a consolidated balance sheet. So whatever I'm telling you is based on the observations of all these four cases, but just, trying to pin down that how I'm going to make my consolidated balance sheet. Step number 1. So I would say in terms of step number 1, you should only note down the date of acquisition and the percentage. That's it. Which you will easily get. When you read the question, you will easily get the data that what is the date of acquisition and what is the percentage. Just note it down. That's it. Now watch the step number 2 carefully. Out of the 4 cases, I would, divide the consolidation in 2 situations. Hear this carefully. So out of all the 4 cases which I gave you, I would divide that there are 2 types of question. I would say there are 2 types of questions when you look at the consolidation. Either you're making a consolidated balance sheet on date of acquisition. It may be without NCI. Can I say this is case 1 and 2? Because 1 was without NCI and 2 was with NCI. That's one kind of question. The second is you make a consolidated balance sheet at a later date. And can I say this is case 3 as well as case 4? So I would say that there are 2 kinds of question. You need to, first of all, before you proceed with the step number 2, just carefully see that is this a question where you're required to consolidate on acquisition date or at a later date? No. Once you've identified that it is either a case where we're doing a consolidated balance sheet on the date of acquisition or we're doing a consolidated balance sheet at a later date, now comes the next course of action. Now, let me ask you something. Please analyze this carefully and vouch me. If you are doing a consolidation on acquisition date, do you know the assets and liabilities of the subsidiary on acquisition date? Go to the case number 1 and 2. Did you know the assets and liabilities of the subsidiary on the acquisition date itself? The individual assets and the individual liabilities? I need to get your vouching done. So when you made the consolidated balance sheet, so in this particular case, do you know the assets and liabilities of the subsidiary company on the date of acquisition? I think yes. If you're doing the consolidation on the date of acquisition, can I say you definitely know what are the assets and liabilities? So what I'll do, I'll take the assets of the subsidiary and I'll reduce the liabilities of the subsidiary and I'll get the net assets on the date of acquisition. So it'll be easy for me to get the net assets. Now, why am I getting the net assets? I need to calculate a goodwill for which I need the net assets of the subsidiary. And if you're given the balance sheet on date of acquisition, you know the individual assets, you know the individual liabilities at each and every date. So I know these are the assets on acquisition date. These are the liabilities on acquisition date. You can make a list of all the assets and liability easily. I hope you got my point, correct? Now let's go to the next one. If you're making a consolidated balance sheet at a later date, remember the case 3 and 4. Do you know the individual assets and liabilities of the subsidiary? Yes or no? If I give you a case 3 and 4, do you know the individual assets and individual liabilities on the date of acquisition, or you only know it at a later date?
We don't know as on date of acquisition.
That's exactly correct. So I do not know the status as on that particular date. So what I'll do, I'll divide my step number 2 in terms of 2 parts. Step number 2A and step number 2B. Now, if you remember something very clearly, I said in terms of consolidation, Indus 110, get into the habit of considering net assets as equity share capital plus other equity. Instead of considering assets minus liability, we will consider equity share capital plus other equity. And I said, no worries, you'll get the logic later. Now, since I do not know the individual assets and liabilities on date of acquisition, I will calculate the net assets as equity share capital plus other equity. But this net asset on date of acquisition, is it going to be the sum total of equity share capital plus entire other equity or pre-acquisition equity? What is earned before the acquisition date?
Before.
That's right. So I need the other equity which is pre-acquisition in nature. And for this particular purpose, when I did case 3 and 4, if you remember, I already gave you the bifurcation of other equity, that this is pre and this is post. The examiner would not give you that information so directly. So what you'll have to do in terms of step number 2A, I will do the analysis of other equity. I will do the analysis of other equity and segregate what is pre and what is post. Let me put it once again. I'm just giving you the logics one time so that you know the logics are there with you. Then it becomes procedural in nature. So let's connect the dots. If you're doing a consolidated balance sheet on the acquisition date itself, the idea is to get the net assets. The objective of step number 2 is to get the net assets on date of acquisition. And the idea is to get the net assets on the date of acquisition. If you are doing the consolidation on acquisition date, it's not a problem because you know the assets individually and you know the liabilities individually. So I can get the assets minus liability easily. But if it is a case of consolidation later, I don't know the status of assets and liability on the acquisition date. So instead of taking assets minus liability, we go with the technique of considering that net assets is equity share capital plus pre-acquisition equity. Now, since we need the pre-acquisition equity, it is important that the equity of the subsidiary is split in terms of what is pre and what is post. When I gave you the case number 3 and 4, I gave you the breakup of that other equity, but that breakup may not be given. So I'll have to sit down in step number 2A, do the analysis of other equity of the subsidiary, segregate the pre and post acquisition. How exactly we'll do that, we'll see in a practical illustration. But once you segregate the pre and post, then I go to the step number 2B to consider the sum total of the share capital and the pre-acquisition equity. Which means in step number 2, your focus is going to be, is it just step number 2 or is it step number 2A and B? If the consolidation is on acquisition date, it is just step number 2, directly getting the net assets. But if it is consolidation at a later date, then it is step number 2A and step number 2B. I hope you got the logic clear. Correct. Now we go to the step number 3. So once you've done the calculation of the net assets, now some sorry. Now some of the steps which you're going to see is going to be, sounding something what you've done in Index 103. Exactly. But the step number in terms of 103 and in terms of 110 could vary. So let's not mix into the steps which you did in business combination and in terms of consolidation. Most of the information is common. Now, in terms of step number 3, I would say you should calculate a purchase consideration. Now, you would say, what is the good need of calculating a purchase consideration? You're technically correct. There is no need to calculate a purchase consideration because generally, the purchase consideration is nothing but the investment which appears in the parent company's balance sheet. So in a very idealistic situation, this purchase consideration is represented by the investment in holding company's balance sheet. If you look at the balance sheet of the parent, you will see this investment and that represents the purchase consideration. Now you would say, so what's the good need of looking at this step number? You can easily get the information. I still insist, better you organize this information in step 3. Then we go to the step number 4. And in terms of the step number 4, I will calculate the NCI. Now please watch this carefully. Now, as far as the NCI is concerned, the NCI on the date of acquisition, is the one computed as per Index 103. So when you calculate the NCI, we will take the NCI on date of acquisition, which is purely as per Index 103, and which is either calculated on the basis of PASNA or it is calculated on the basis of fair value. Now let me ask you in terms of case number 4. Did you add anything to the NCI in case 4? Did I add to the NCI something in case 4? Did I add the share in the post-acquisition profits to the NCI? Yes or no?
Yes.
Yes. So I will add the share in post-acquisition profits. Because if you remember in case number 4, we said out of that profits, 80% belongs to the parent and 20% belongs to the NCI. So when you take the NCI on acquisition date, remember to add the post-acquisition share and then you get the NCI on the consolidation date. 103 gives you the NCI on acquisition date. And the objective of getting NCI in 110 is getting it on the consolidation date. Remember, this is the NCI on consolidated balance sheet date. 103 gives you the status on the acquisition date. Then comes the step number 5. Thereafter, we go to the step number 5. In terms of the step number 5, we need to calculate the goodwill or the capital reserve. And trust me, this is 100% same what you did in terms of 103. So you took the PC, which is investment here, at the NCI on the rate of acquisition, compared it with the net assets in step 2. So you can see it is exactly same as Index 103. Whatever you did in 103, 100% exactly same. So in other words, if you consider the data, you take the purchase consideration that's available in step number 3. To this, we add the NCI, but remember the NCI on the date of acquisition, not on the balance sheet date, which is in step number 4. We get the NCI on the date of acquisition, and you compare this with the net assets that is available in step number 2. That is step number 2B, ideally, I would say. So you add the PC and the NCI, compare it to the net assets, you're going to get the goodwill or the capital reserve, as the case may be. 100% same. 100% same what we have done in 103. Now you can see that the idea of calculating step number 2 is to organize the net assets for goodwill. The idea in terms of step number 3 is carrying the PC for goodwill. So the main focus in all these steps is to calculate the goodwill NCI, which is to appear as a separate line item. So when you organize the information in step number 2 or in step number 3, the focus is goodwill NCI. So once you've organized step 2 and 3, the focus is to get the NCI and the goodwill, which will appear as a separate line item. So all that is going to be organized on a very systematic basis. Let's go ahead. We go to the step number 6 now. The next is we go to the step number 6. And I would say in terms of step number 6, the focus is to calculate the other equity in the consolidated balance sheet. The idea is to organize the consolidated balance sheet other equity. Go to the case number 4. When you took the other equity, you took the equity of the parent and you added the post-acquisition share. Out of the 50, you took 80%. So I would say let's make a separate working note. We need to consider holding company's own other equity. And to this we add the share of holding in subsidiary, that is post-acquisition profits. The share of parent in subsidiary post-acquisition profits as well. That's it. So if you remember, if we took the other equity of the parent and we took 80% of that 50 post-acquisition in the other equity calculations. And finally, we come to the step number 7. In terms of step number 7, now it is to make a consolidated balance sheet. I hope you're able to get the logics now in terms of these 7 steps. As I will proceed to the questions, we'll go systematic one by one, looking at the data. Okay. Now, in order to make the consolidated balance sheet, I gave you 5 rules earlier, and I'm just going to pen down all those 5 rules of consolidation, which you need to keep in mind. The first rule is investment, which the holding is got in the subsidiary, doesn't appear in the console. The second rule is that equity share capital of subsidiary company does not appear in the console. The third is the other equity, which is pre-acquisition of the subsidiary company, does not appear in the console. 3 things do not appear in the console: the investment, the share capital of the subsidiary, and the pre-acquisition other equity. And 2 things appears in the console: consolidated balance sheet and NCI will have to appear as separate line items. The goodwill and the NCI will appear as a separate line item in the consolidated balance sheet. And the last one is we aggregate. We aggregate all assets and liabilities. We aggregate all assets and liability, and that is 100%, irrespective. It is irrespective of the percentage. Irrespective of the percentage held. You may not be having 100% stake in the subsidiary, that doesn't make a difference. Irrespective, the consolidation would always be 100%, and that is the reason this technique in Indes 110 is called a full consolidation technique. Because we aggregate all the assets and liability, it is called a full consolidation technique. So I penned down all my thoughts in a very chronological order, that how you're going to proceed with the concept of consolidated balance sheet. Okay, let me now just connect the dots. And then I think let's take the journey forward. Let me just quickly connect the dots out here once again. So what we're looking at is when you're doing a consolidated balance sheet, your focus in terms of step number 1 is just organizing the acquisition date and the percentage. As simple as that. Just look at the question, get the data, get the acquisition date and percentage. That's it. Step number 2, you need to focus on the type of the question. If the consolidation is on the acquisition date, just organize the list of assets and liability. That's it. But if the consolidation is at a later date, you need to segregate the data in terms of step number 2A and B. In step number 2A, analyze the profits, other equity in terms of pre and post. Instead of taking the net assets as assets minus liability, you will take equity share capital plus the pre-acquisition equity. The step number 3 is organizing the purchase consideration, typically the investment in the balance sheet. The step number 4 is getting the NCI on the balance sheet date. NCI on date of acquisition as per 103 and adding the post-acquisition share in profits. Then step number 5 is calculating goodwill capital reserve exactly the way you do in Ind AS 103, nothing different. Then step number 6, you need to organize the other equity in the consolidated balance sheet, the parent company's own equity, and the share in the post-acquisition profits, which you will get from step number 2A once you do the analysis. And step number 7 is making a consolidated balance sheet by keeping these 5 golden rules into account, 3 things which are not taken and 2 things which are taken in the list. And that will give me a consolidated balance sheet. This all is the steps without considering any of the adjustments. Because when you go to get a question in the exam, you will not get a question without any adjustments as well. This is plain vanilla application of the consolidation process without any adjustments altogether. I hope, friends, I stand very clear on my thoughts right now. So far, so good, correct?
Yes, sir.
Okay, that's wonderful indeed. Now what I'm going to do, I'm now going to introduce you to the adjustments. Or do you want me to do a small question without any adjustments at this stage? Or this is pretty good? If you want, I can take a question where I show you this entire process of consolidation without adjustments, and then I can add adjustments. Or if you're comfortable, I can directly go to the adjustments. Your choice. What do you want me to do? So in third rule of step number 7, it is pre or post acquisition which is not to be taken to other equity. This is pre-acquisition which is not taken. In step number 7, the other equity pre-acquisition is not taken. Just to make a mention, post-acquisition is taken. The post-acquisition is taken. So we do take the post-acquisition into account. Correct. Okay, so what do you want me, friends, to do? You want me to do a question without any adjustments or directly jump to the adjustments one by one? So as your comfort, I'll do accordingly. So you want me to do a question without adjustments for the time being to get the flair? Okay, no issues. I will just share a small little question to you. Just give me a second. We'll pick up a small little question right now to give you a flavor of how the consolidation is going to be done without any adjustments for the time being. Just give me a minute. I'm just going to share a question on the screen to you. Okay, so I'm now going to give you a small little question. This is going to be in small little two parts. Maybe you can take a snapshot of the question so that I can organize the data. I'm just going to share it on the screen for your benefit. You will never get a question on this lines. Actually, it's too easy for you. So just have a snapshot of this question. I'm just going to read the data to you. So I am given the information in the question, and it says the balance sheet, the following statement of financial positions are prepared on December X8. So you're given the balance sheet of Dickens and Jones. So if you can just take a note of this data, I'll show you another snapshot. Maybe you can take a screenshot at this stage. Right, can I go ahead? Okay, so let's, I think, share another part of this. So I'm now sharing some additional information out here. We'll go step by step just to have a little feel of how the 7-step model is to be applied. So this is now the requirement, the additional data given in the question. It says Dickon acquired 16,000 ordinary shares in Jones on January X8, when Jones' retained earnings stood at 20,000 and the share premium is 10,000. On this date, the fair value of the NCI is also given. Dickon uses the fair value method to value the NCI. We're required to make a consolidated balance sheet. If you can just take a note of this as well, that would be great. Right, so let me know once you've taken a snapshot of the screen, then I can take it further. Okay, that's wonderful indeed. Now let's come back to the information. Okay, so I am now going to start the process of consolidation with a very simple little question. So this is the example which I gave you. So we're just going to learn how do we apply the 7-step model in a question without adjustments. Then we'll go to the layers of adjustments. So first of all, step number 1. The idea is to get the date of acquisition and the percentage. So can you look at the data and tell me what is the date of acquisition? I think you can easily see that what is the date of acquisition. So if I just make a walkthrough, I think the date of acquisition is given to me 1st January X8. So I'm very clearly given that 1st January X8 is the date of acquisition. And I think if you look at the percentage, he acquired 16,000 shares out of 20,000 share. So the percentage in this case is 80%. By the way, the balance sheet is on December X8. Now, would you like to tell me what is the type of the question in step number 2? Is it consolidation on acquisition date or is it later?
Later.
That's absolutely correct. So we are on step number 2. You need not tell the examiner that, I'm identifying the type of question. This is only for your reference. So we will say, what is the type of question? So I will say, in this case, the type of question is that the consolidated balance sheet is at a later date. So can I say there will be 2 steps now which will be done? Just for reference, we're going to go to the step number 2A. And we're going to go to the step number 2B. In terms of step number 2A, we'll do the analysis of other equity. And in terms of the step number 2B, we'll get the net assets on the date of acquisition systematically. Now let's do one thing. Let's do the step number 2A, analysis of other equity. So I go to the step number 2A, and when you do the analysis of other equity, we'll just organize the information in a very systematic manner. So in the analysis of other equity, just make a small little chart. Dividing this in 3 columns, one is particulars. The other is we define what is pre-acquisition. And the other one is defining what is post-acquisition. So go systematic and make a format for the analysis. Divide this in terms of pre and post-acquisition. So when you say pre-acquisition, I'll say this is pre-1st January X8. Anything which is earned before the acquisition date becomes pre-acquisition, and you can say anything from the date of acquisition till the date of balance sheet, that is December X8, is post-acquisition. Define it in terms of the dates, what is pre and post. Tell the examiner pre-acquisition is pre-acquisition date and post-acquisition is from anything from the date of acquisition till the balance sheet date. Now, I want you to do something. Go to the balance sheet of the company and see what is the status of other equity in the subsidiary's balance sheet. I think if you look at the other equity in the balance sheet of the subsidiary, I think you can clearly see that there is an information, two informations given. There is a share premium and there is retained earnings. I think I'll just share the screen once again to see the larger picture very clear. Just have a look at this data once again. If you look at the balance sheet of the subsidiary Jones, we can see that there is a share premium to the extent of 10,000 and there is a retained earnings to the extent of 25. The idea is to analyze that out of this premium, how much is pre and post? And out of this retained earnings, how much is pre and post? So we're analyzing these two figures. So I'm just removing the screen once again. So we will do the analysis based on this information. So let's begin with the share premium. Now, my advice would be that when you do the analysis, please make a timeline. See what is the balance at the beginning and see what is the balance at the end. Whether you do the analysis of the premium or you do the analysis of the retained earnings, make a timeline and analyze. Now go to the additional information and see what is the status of premium on the date of acquisition. So I am very clearly given that the premium on the date of acquisition was 10 and the premium on the balance sheet date is also 10. So can I say the premium on acquisition date was 10? So there is no change in the post-acquisition period. Can I comfortably say that this entire 10,000 is pre-acquisition? Yes. The balance on the date of acquisition was 10 and the balance on the balance sheet date is still 10. There is no movement in the post-acquisition period. Everything was earned before the date of acquisition. So this entire 10,000 becomes pre-acquisition in nature. Similarly, we can also pick up the retained earnings and in the retained earnings also make a timeline and see the status at the beginning of the year and see the status at the end of the year. So if you look at the retained earnings in the balance sheet, so we can see the retained earnings, dividend adjustment is different final than an inter. Yes, we will be coming to that later. Don't worry, not at this stage. Right now we're doing a question without any adjustments. So retained earnings is given to me 20,000 in the additional information and the retained earnings is 20,000. 25,000 in the balance sheet. So this was 20 on the date of acquisition and it was 25 at the end of the year. So can I see in this particular case, this 20 is pre-acquisition? Because this was the balance on the date of acquisition and this increase of 5,000 becomes post-acquisition in nature. That's it. So the analysis of the equity is done. If you make your analysis on a systematic basis, just make a timeline and see the balance on the date of acquisition, the balance at the end of the year, the balance on the date of acquisition is pre, and whatever is the change is the post-acquisition. Correct. So now let's take the sum total of this. My analysis is done. This is 30 and this is 5. So this takes care of the analysis of the equity. That is step number 2A. Now let's go to the next one. The next one we're looking at is step number 2B. And in terms of the step number 2B, we need the net assets on date of acquisition, the sum total of the equity share capital and the other equity, which is pre-acquisition in nature. As we decided that when you need the net assets on the date of acquisition, you just need to consider the equity share capital plus the pre-acquisition other equity. So let's take the sum total of this. Go back to the balance sheet and see what is the equity share capital. And I guess the equity share capital of the subsidiary in the question is to the extent of 20,000. So we take this equity share capital 20,000 and the pre-acquisition equity is 30. So that makes it a total of 50,000. That is the net assets on the date of acquisition. Great. So this is pretty simple and straightforward question indeed. You will not expect this kind of question exactly coming in the exams. Okay, I guess, sorry, I'm a weak network area. Will definitely watch the recording. Would be really obliged if you could mention it. I did Goodwill, Goodwill impairment adjustments directly. Yes, I will be doing all those adjustments. Don't worry. After this, we'll be covering a total of, a couple of adjustments after this. This is a question without adjustments, as we said. We'll be coming to a question with adjustments also very soon. Okay, I can see that, your network is going and coming back again and again. I understand that. Okay, let's now consider the step number 3. The next agenda is the step number 3. And step number 3 is calculating the purchase consideration, indirectly calculating the investment, which is appearing in the balance sheet of the parent company. So let's, I think, go to the balance sheet and let's see the investment. So investment is appearing to the extent of 60,000. So that is step number 3. Then we go to the step number 4. I know whatever I'm doing right now is too easy a stuff, but trust me, unless the foundations are absolutely clear, we might face a problem in the larger question. So I'm going slow. I want you to get the grip of the techniques of doing consolidation. Then we'll enter the adjustments area. The step number 4 is calculating the NCI. And in terms of NCI, we are very clearly given the NCI on date of acquisition at fair value. So it's very clearly stated in the question that NCI is being taken at a fair value. So let's see the data given in the question. So we're given the NCI at a fair value is to the extent of 12,500. So that is the NCI on date of acquisition. And to this we will add the share in post-acquisition profits. We will add the share in the post-acquisition profits. And this is available in step number 2A, where we've calculated the post-acquisition earnings. If you go back to the step number 2A, the post-acquisition profit is to the extent of 5,000. And out of this 5,000, 20% belongs to the NCI, and that works out at 1,000. So the total in this case is 13,500. Absolutely correct. That's great. So step number 4 is done. Then we go to the next one. That is step number 5. So in terms of the step number 5, now it's time to calculate the goodwill or the capital reserve, as the case may be, which is just organizing the information. So we take the sum total of the purchase consideration and the NCI, compare this with the net assets on the date of acquisition, and we get the goodwill or the capital reserve. Now the purchase consideration is in step number 3, that is 60,000. And be careful, when you consider the NCI, we need the NCI on the date of acquisition, not the complete NCI in terms of step number 4. So we need the NCI on date of acquisition. That's 12,500. And the net assets on the date of acquisition is 50,000. So I think this works out at 22,500. This difference is the goodwill. Okay, that's wonderful indeed. Okay, so now we are ready in terms of the step number 6, getting the consolidated balance sheet other equity. So let's go to the step number 6. So in terms of the step number 6, we need the consolidated balance sheet, that is other equity. So for this purpose, we'll just organize the information. The parent company has got two elements. It has got a share premium as well as a retained earnings. So we'll get the segregated information for both the items. So let's take a data particulars and then security premium or share premium and the RE. So we just need to take the parent company's own retained earnings and premium and add the share in the post acquisition. So let's see holding company's own premium and RE. Let's go back to the balance sheet. So if you look at the balance sheet of the parent company, the share premium is 35 and the retained earnings is 70. And to this, you can add the share in post-acquisition profits. We can add the share in the post-acquisition profits, which you've done in step number 2A already. And in terms of the step number 2A, we just have that 5,000 retained earnings post-acquisition. So out of that 5,000, we take 80%, and this will be added to the retained earnings. And I think that's it. So this is the only entry which comes out here. So this is 35, and this is supposed to be, this is 35, and this is 74. So this gives us the status of the step number 6, that is a consolidated balance sheet, other equity to be presented in the console. Finally, we come to the step number 7. Now, when I do the step number 7, I would, create a simple format where a consolidation can be done on a step-by-step basis. So let's go to the step number 7. So this is making the consolidated balance sheet. And I think the easiest way of making a consolidated balance sheet now is we just going to follow a simple format. So I will take one column for the holding company, one column for the subsidiary, one column for the adjustments, and I'm going to get the total column as well. So my consolidation, so when I'm going to do my consolidation, I will create some columns for the consolidated balance sheet, the parent company, the subsidiary company, adjustments, and the total. So that will give us a good track. So we'll take the balance sheet of the holding, subsidiary, any adjustments to be done, and we'll get the total. Right now, there is hardly any significance of the adjustment column because we've not done any adjustments, but trust me, I am going to follow the same sequencing and format in all the questions, irrespective of the intensity. So let's begin with the asset side of the balance sheet. So if I start with the asset side of the balance sheet, on the non-current assets, I am given property, plant, equipment. So the parent company is 85,000. And the subsidiary company is 18,000. And there are no adjustments given. So we just add 85 plus 18, that's 1,03,000. No adjustments given for PPE. Next item, investment that would not appear in the console based on our rules. Then we've got the current assets. The current assets is 1,60,000. And this is 84. So the sum total becomes 244. There are no adjustments. But I think least we forget, let's consider the goodwill. So we've already calculated the goodwill The goodwill was 22,500. So let's fit in this goodwill also in the balance sheet. I guess that's it on the asset side. So let's see the sum total of the asset side. So 1,03,000, 22,500, 244. This is 369,500. Then on the liability side, we've got equity. Equity share capital. This will be only for the parent company. That is 65, directly putting into the total. Then as far as the other equity is concerned, look at the step number 6. Look at the step number 6. And I'm just going to add the breakup. So let's add this 35 plus 74. That makes it 1,09,000. So this is the other equity in the balance sheet. And remember to take the NCI as a part of this other equity itself. So when you present the equity in the balance sheet, NCI will always be a part of this. So NCI is appearing at 13,500. So that would also be a part of the equity section. There are no non-current liabilities. We just have the current liabilities. The current liabilities is 135 and this is 47. So we take the sum total of this. It is 182. And I think that's it. We can now see the total of the balance sheet. Hopefully the balance sheet should tally. 65, 109, 13,500 and 182. This comes to 369,500 is the total of the balance sheet. Wow. I guess, friends, you would have got a basic flavor of how the consolidation using the 7 steps is to be applied. The idea was just to give you a basic flavor of the 7-step model which I gave you. This kind of question can never ever come in the exam. The idea was only to give you a basic movement of the 7th step. I hope you are now absolutely comfortable in terms of applying the 7-step model, correct? Clear, that's wonderful indeed. Okay, now what I'm going to do is something very crucial indeed. And let me give you a chain of thought with which I am going to take the journey forward. I'm now going to discuss, a certain specific adjustments based on the kind of adjustments which comes in the exams. I have segregated the adjustments into almost like, 5, 6 kind of adjustments. So I will discuss with you the adjustments now related to number 1, that there is intercompany owings. The second adjustment we're going to discuss is the unrealized profits, what we call stock reserve. The third adjustments we're going to discuss is the concept of fair value adjustments. The next adjustment we're going to discuss is the concept of goodwill impairment. The next adjustment which we're going to discuss is the omission entries which can occur. So I'm going to divide my entire discussions in terms of 5 adjustments. And as I discuss these 5 adjustments with you, once I've given you the logic of these 5 adjustments, I would request that you should map your mind that if this adjustment comes, then it is going to hit which step. Because once we know that there is a 7-step model, for each adjustment, we need to be clear that this adjustment is going to be taken in this step. So I'm going to map your mind in such a way that once we are done with all the adjustments, you are able to correlate that this adjustment will impact step number so and so. This adjustment will impact step number so and so. So we'll do our independent discussions of adjustments. And based on that, we will also keep mapping the step numbers where these adjustments will get impacted. Then we will come to a full-fledged questions where we get all the adjustments, simply in the question. Let's begin the journey. I'm now starting my discussions on specific adjustments. I'm now starting my discussions on the specific adjustments with you. So as I said, as I discuss the adjustments with you, then we will correlate that this adjustments will impact with step number. But first, let's understand the adjustments on separate basis. Let's consider the adjustment number one. Let's consider the adjustment number one. And that is intercompany owings. That is intercompany owings. Let's take an example to understand this particular adjustment, that is intercompany owings. Now, it is quite possible that before the acquisition, before the control is acquired, or maybe after the control is acquired, generally we will presume that things are happening after the control is acquired. Mind the words. Though it is possible that before the acquisition date, they deal with each other, but that's more like, a pre-existing relationship. And the pre-existing relationship, is already taken care in 103. So now when I'm going to look at intercompany owings, the focus is that everything occurred after the acquisition date. So we're going to focus on the fact that all this intercompany owings is arising post-acquisition date. The parent company and the subsidiary company made a sale to each other, creating a debtor-creditor. So we're looking at intercompany owings in terms of receivables and payables in both the books of accounts. So let's consider an example. Let's consider an example. Let's say this is the balance sheet of the holding. Let's say this is the balance sheet of the subsidiary. And let's say this is the consolidated balance sheet. So this is holding company's balance sheet. This is subsidiary company's balance sheet. And let's say this is the consolidated balance sheet. I'll give you two variations in this particular intercompany owings. So watch this very carefully. Let's say in the balance sheet of the holding, there is a trade receivable. The parent made a sale to the subsidiary company in the post-acquisition period. And let's say 5 lakhs trade receivable is appearing in the balance sheet. The subsidiary is reflecting a trades payable of an equal amount, that is 5 lakh. Now, when you do the consolidated balance sheet in the trade receivable, you'll add the holding and subsidiary. In the trades payable, you will add the holding and the subsidiary, applying the rules which I gave you in step number 7, aggregating the assets and aggregating liabilities. Now, you would absolutely agree with me. The sum total of this includes 5 lakh. The sum total of this also includes 5 lakh. So I'm saying I need to recover 5 lakhs from myself. And I need to pay 5 lakhs to myself. So what do we need to do in this case? We reduce this 5 lakhs. And we reduce this 5 lakhs. This is called elimination of intercompany owings. I think makes complete sense. That when you aggregate the assets and liability, then that 5 lakhs will get aggregated on the assets and liabilities both. So we will eliminate that 5 lakhs from the receivable, will eliminate that 5 lakhs from the payable, and that will eliminate the process. Would you like to make a guess that this impact will be taken care in which step? Out of the 7-step model, what do you think I should take care of this in which step number? Any guess on that? Will it impact any other step, or do you think I can comfortably take care of this in the consolidated balance sheet and take care of this in step number 7 itself? Correct? Yes.
Yes, sir. Yes, sir.
Absolutely. Now, let's create a small little variation. Based on the same example. Let me give you a slight little variation now in this case. Let's say the trade receivable is 5 lakh. And let's say the trades payable is 4 lakh. It's not reconciled. This is a case where it is reconciled. And this is the case where it is unreconciled. So I'm taking two different cases, reconciled and unreconciled. Now, what's the data carefully? The subsidiary company says that I have to pay you 4 lakh. The parent company says, no, boss, you need to pay me 5 lakh. The subsidiary says, I've remitted the money and it is in transit. You have not received the money. I have already remitted the money, but you have not received the money. Now, my question is, when you take the trade receivable holding plus subsidiary, or when you take the trades payable holding plus subsidiary, how much will you eliminate from the trade receivable? 5 or 4?
4 lakhs.
No. In this particular case, he says, I have to receive 5, so I will eliminate 5 lakhs from the receivable. How much do you think I'm going to eliminate from the payables? I aggregated 4, remember? So I'll eliminate 4 lakhs, that's right. But this will not tally my balance sheet. So what I'm going to do, that 1 lakh rupees is in transit on the asset side. You are going to show the cash in transit to the extent of 1 lakh. So let me put this once again. He says, I owe you 4 lakh rupees. He says, no, I need to recover 5 lakhs. In my consolidation, I will eliminate from the receivable 5 lakhs itself. I will eliminate from the payables 4 lakh itself. That 1 lakh which is sent by the subsidiary, but it is not yet collected, is in transit. So the cash in transit will be reflected as a separate line item in the balance sheet. Right, friends, I hope I stand clear on the adjustment number 1. By the way, let me tell you, it would not make any difference whether the receivables and payables are in whose books of accounts. That means, in the given example, if this was a case of a trade receivable and this was a case of a trades payable, the accounting treatment is not different. In the adjustment number 1, whether it's a trade receivable in the books of the parent or it's a trade receivable in the books of the subsidiary, it does not make any difference to my accounting. I will simply, when I go to the step number 7, I'll eliminate the intercompany owings. Whatever is the amount included in receivable, out. What is the amount included in liability, out. If there is an unreconciled balance, I would consider that the money has been sent, but it is not yet collected. So I'm going to capture the cash in transit in that case. Right? I hope adjustment 1 absolutely clear.
Will it make a difference if the trade receivables are less and trade payables are more? Then
That's a good question indeed.
it will mean then it will, yes sir,
Yes.
cash sent.
So, right. So you say this is 5 and this is 4, correct?
Yes sir.
Yes. Now, if this is 5 and this is 4, that means I need to pay more. Then I would assume that it's an unreconciled balance and there is a dispute. So in this particular case, I'll eliminate that 4 lakh rupees from both receivables and payable, and the unreconciled or the disputed balance will continue in the balance sheet. Right.
Right sir, thank you.
You're welcome. Now let's come to the next adjustment, that is adjustment number 2. The adjustment number 2 is with reference to what we call unrealized profits. It is unrealized profits, or it is also called stock reserve, or is it also called stock reserve. Now here the things will get slightly more complicated when you look at the unrealized profits, or you can say the stock reserve. Here again, let me tell you that we are assuming that the sale and purchase took place in the post-acquisition period. So in all the cases, whether it is intercompany owings or it is a case of stock reserve, we are always assuming that the sale took place in a post-acquisition period, because pre-existing relationships is in any case being settled under Ind AS 103. Now, in this case, we need to be careful. In this case, we need to be very careful. Unlike the previous case, now we need to be careful. If you're looking at the concept of unrealized profits or stock reserve, you need to see that is it an downstream transaction or is it an upstream transaction? Now, what is a downstream and upstream transaction? If the sale is made by the parent company to the subsidiary, it is down. When the sale is made by the subsidiary to the parent, it is upstream. The accounting treatment in this case will be different if it is downstream and upstream. In intercompany owings, it does not make a difference, it is down or up. The treatment was same. But in terms of the unrealized profits, it makes a difference. So we'll first of all evaluate whether it is supposed to be a downstream transaction or it is supposed to be an upstream transaction. So when I say it is downstream, it is a sale by holding to subsidiary. It's down. And when you say upstream, it is a sale by the subsidiary to the parent. It is called upstream. So you'll see that the sale is made by subsidiary to the parent, upstream, or is it downstream in nature? And accordingly, the treatment will vary. So first we'll make a walkthrough of both the transactions and then translate this adjustments is going to be tackled in which particular step. So let's first visualize the data. Let's say this is the balance sheet of the holding and this is the balance sheet of the subsidiary, and let's say this is the console. Here also we'll take an example where we'll take the balance sheet of the parent, subsidiary and the console. So let's visualize the transactions now. So let's say this is the holding company balance sheet, subsidiary company balance sheet, and console. Now, when I say it is downstream in nature, the parent made a sale to the subsidiary. Now, let's say goods costing 10 lakhs is sold at 12 lakh. Let's say the goods costing 10 lakh is sold at 12 lakh. Can I say he made a profit of 2 lakhs on the deal? And he purchased the stock and the cost of the stock is 12 lakhs. So I'm assuming that the goods are costing, the cost price of the good is 10 lakh and it is sold, let's say at 12 lakh. So the buyer would record this at the cost to him, which is 12, and the seller would record a profit of 2 lakh rupees. Now the question arises from the group point of view. The question rises from a group point of view. Do you think this profit is realized or unrealized? The parent made a sale to the subsidiary and now you're aggregating the assets and liability. So is this profit realized or unrealized from the group perspective? It is unrealized.
Unrealized.
So, yes. So what I should do, when you take the stock, I will eliminate that 2 lakhs out here. And when you take the other equity, I'll eliminate this 2 lakhs out here. Makes logical sense. So whatever is the unrealized profit gets eliminated from the figure of stock, and this profit is also eliminated from the other equity as well. Now let's give you a little variation before we go complicated. Let's take another variation in this case. Let's consider that he made a profit of 2 lakhs on the deal, of course, because but now he's got a stock unsold only 6 lakh. 50% of the goods have been resold to a third party. So the parent made a sale of goods 12 lakh rupee, but 50% goods is being resold to a third party by the subsidiary company. So should I eliminate the profit to the extent of 2 lakhs or only 1 lakh?
1 lakh.
That makes sense. So can I say we should eliminate only the profit which is on the unsold goods? So moral of the story, that when you eliminate the stock reserve, what you need to keep in mind is that the unrealized profits will be eliminated. The unrealized profits will be eliminated only on unsold goods. We will see what is the portion of the unsold goods and we'll eliminate the unrealized profits on the unsold goods only. Makes sense? So here we have got two cases. One is 100% unsold. That is one case. And the other case is that it is partly unsold. So that will be giving us a clear-cut position that if it is partly unsold, the unrealized profits will be eliminated to the extent of the unsold goods only. But I want to translate this in terms of what you're going to do in the various steps. So let's understand what you're going to do in the various steps. Watch me carefully. Can I say this adjustments can be taken care in the step number 7. Is my thought correct? The reduction in the stock can be taken care in the step number 7. And what about this reduction in other equity? Can it be taken care in step number 6 when you take the other equity? Make sense? I'm just translating where these adjustments should be taken care. So as far as the elimination of the profit is concerned, you can eliminate that in other equity, step number 6. Elimination from the stock in step 7. So if it is downstream, I will make changes in step number 6 and 7. Great. Let's now go to the next agenda. Let's consider upstream. So let's say this is the balance sheet of the parent and the subsidiary. And here again, we will take unsold partly as well. Now let's say it's the other way around. So the other equity of the subsidiary includes 2 lakh. And the stock is included in the parent company's balance sheet. Now when I take the stock, I will eliminate this 2 lakhs from here. But the question arises, what do we do with this elimination of profit? Now, hear this carefully. Does this 2 lakh enter the other equity of the console, or does it get divided between the parent and NCI? This is a part of the post-acquisition profits of the subsidiary. And can I say this will be divided between the parent and the NCI? Because when you do the step number 2A, you have done the analysis of equity. So can I say this will be split between pre and post? And if it is a post-acquisition sale, it becomes a post-acquisition profits. So can I say if there is a 80% belonging to the parent company, can I say 80% would have entered the other equity and 20% would have entered the NCI? So which means that out of this 2 lakhs, if 80% entered the other equity, we should eliminate 80% from here. And can I say 20% should be eliminated from NCI? Does it make sense? Correct. So this is the equity which is split between the parent NCI. So if I assume that the holding has got 80% stake in the subsidiary, then out of this 2 lakh, 80% got added to the other equity, 20% got added to the NCI. So eliminate the parent share from the other equity and the NCI share from the NCI. Makes logical sense. But I want to translate what you're going to do in terms of the different steps. Now, please hear this carefully. Please hear this very carefully. The elimination of the stock can be taken care in step 7 undoubtedly. But the elimination of other equity and the NCI needs to be taken care in which step? Now, hear this carefully. When I do the analysis step number 2A, when I do the analysis in terms of step number 2A, if I reduce the post-acquisition profits by 2 lakh rupees, just imagine. When I do the analysis of other equity and I reduce that 2 lakhs from the other equity, so from the post-acquisition column, if I reduce that unrealized profits, can I say automatically the parent share and NCI share will get adjusted? Am I making sense? So you can eliminate this from the step number 2A in the post-acquisition column. So when you eliminate that in the post-acquisition column, the post profits will decline. So when you give the profits to the parent and the NCI, they automatically get a reduced share. So what I'll do, in this case, I'll eliminate this from step number 2A. I'll reduce it from post-acquisition profits. Did you get my inputs? Did you get my inputs? That I will eliminate this profit from the post-acquisition profit in step number 2A. In the analysis, I'll remove that unrealized profits. So the parent share in post-acquisition and the NCI share automatically gets converted. Got my point? The total 2 lakhs? Yes. I'll eliminate that entire 2 lakhs from the post-acquisition column. Because when you eliminate that 2 lakhs from the post-acquisition column, the post profits will decline by 2. 80% of the declined profit goes to the parent. 20% of the declined profit goes in the NCI. So automatically things will get converted easily. Got the point? Okay, so moral of the story, let me just connect the adjustment number 2. I think let me put some rapid fire questions to you at this stage based on the 2 adjustments. So when you say it's an intercompany owing, can I say irrespective it is down or upstream, elimination will be in step number 7, correct? If it is intercompany owings, downstream, upstream, doesn't make a difference. Elimination will be in step number 7, eliminate the debtors, creditors, that's it. Great. Next. If it is a case of intercompany owings, can I say it makes a difference? It is downstream or upstream. If it is downstream, step number 6 and 7. If it is downstream, I'll take care in step number 6 and 7. Reduction of the profits from the other equity and the stock figure. And if it is upstream, then step number 2A and 7. Got the point, I guess. So far, so good, friends. Clear on this? Then I think we can go to the next adjustment. Now we need to go to the adjustment number 3. Now we need to go to the adjustment number 3. And the adjustment number 3 is what we call fair value adjustments. The adjustment number 3 is what we call the fair value adjustments. So let's see what is this fair value adjustments. If you remember in Index 103, when you took the list of net assets on acquisition date, we took the fair value. In Index 103, when you took the list of the net assets, we took the list of the net assets at a fair value. Because when you are calculating the goodwill, you take the PC versus the net assets at a fair value. Now, watch this carefully. Let's first understand the inputs. This is the balance sheet of the subsidiary. This is the assets of the subsidiary, and this is the liabilities of the subsidiary. This is the equity share capital and the other equity. Now tell me, is this assets and liabilities at book value or is it at fair value in the balance sheet of the subsidiary? So the assets and liabilities are at book values or at fair value. That's correct. It is at a book value. Does this also mean that indirectly when you take the sum total of this, this is going to give you a net assets at a book value itself? But we need to get the net assets at a fair value. So as a part of the consolidation adjustments, he will give you a fair value of the assets and liabilities on the date of acquisition. In the additional information, he will tell you that this is the fair value of the assets and liability. Now, the idea is to convert the net assets at a book value to net assets at a fair value. So how will I take care of this? Let's understand. So when I go to the step number 2A, let's visualize the step number 2A. So when I go to the step number 2A, I will consider this is pre, this is pre, and this is post acquisition. Now, what's the logic? Very carefully. You took this other equity, divided this between pre and post. Is this at a book value or is this at a fair value? Watch this carefully. So you took this other equity in the balance sheet, and that's right. So this is at a book value. So if this is at a book value, what do I need to do? I need to translate this at a fair value. So what I'll do, I'll take the differences between fair value and the book value for all the assets and liability in the pre-acquisition column. So what I'll do to convert this from a book value to a fair value, all the fair value changes, increase or decrease, all the fair value changes, whether it's an increase or whether it's a decrease, will be taken in the pre-acquisition column. So this will automatically convert this will automatically convert, you can say, things at a fair value. So when I take the other equity at a book value, add the fair value changes or reduce the fair value changes, the sum total of this will convert it into a fair value. But I also need to be careful. When you take any asset at a fair value, the depreciation will change on a prospective basis. The depreciation will change on a prospective basis. So what I'll have to do on account of this, since there will be a prospective change, since there will be a prospective change in depreciation, so I will take care of the additional depreciation in the post-acquisition column. So in terms of the step number 2A, I will take the fair value changes in the pre-column and I'll take the additional depreciation or maybe the reversal of excess depreciation in the post-acquisition column. That's one. Secondly, when I come to the step number 7, making a consolidated balance sheet, when I come to the consolidated balance sheet, under step number 7, now let's see what am I supposed to do. When I come to the step number 7, I have taken the assets, for example, holding plus subsidiary. So to this, what I will do, I will also add the fair value and book value difference out here. I will add or reduce as the case may be. Because this assets and liabilities are at a book value, so in the balance sheet, the fair value changes will be incorporated in the value of these assets. And I will also reduce the additional depreciation from here as well. So let me just connect the dots once again out here. So when you look at the concept of a fair value adjustments, we know that on the date of acquisitions, all the assets and liabilities are taken at a fair value. So in this particular case, since I need to take the net assets at a fair value, you need to take care in step number 2A and 7. In terms of the step number 2A, what you will do, you will consider the fair value changes in the pre-acquisition column, converting the book value to a fair value approach. And you will also consider the changes on a prospective basis on depreciation. So the fair value changes will be taken and the depreciation changes in the post-acquisition. So the fair value changes will always be pre, because that is done on the date of acquisition. The depreciations will always be post because it is done on a prospective basis. Now, these changes are also to be incorporated in the balance sheet. So when we take the assets, we will take the assets holding plus subsidiary. The fair value gain or loss will be adjusted in the asset value. The additional depreciation or reversal of excess depreciation will also be taken care of. So the focus would be in terms of step number 2A and 7. So intercompany owing, step number 7. Stock reserve, if it is downstream, 6 and 7. Stock reserve, if it is upstream, then it is step number 2A and 7. And fair value adjustment, step number 2A and 7. I hope you're able to map up your mind that when I look at the adjustments, which step number do I need to take care? Because if you tune yourself, the logics are there, but if you're able to tune yourself in terms of the thought process, how to proceed, then it's going to be simple. Because at the end of the day, after you understand the logic, then it is completely procedural in nature. So get the thoughts clear. If it is intercompany owing, step 7. If it is upstream stock reserve, step number 2A and 7. If it is stock reserve downstream, step number 6 and 7. If it is supposed to be fair value adjustments, step number 2A and 7. Third adjustment is done. We've got 2 more adjustments. One is on the goodwill impairment and one is on the omissions. But I think we'll take care of that later. I think first it's time to give you some break as well. We'll talk of 2 more adjustments, then we'll start doing questions which contains these adjustments. Then you know that as I read the adjustments, get your mind mapped. Okay, this is the adjustments. This is what I need to do in the particular step, and this is what is to be done in that step. Right, friends, so far so good. I hope you're able to map up your minds on the adjustments so far. Time to give you some break now. So 10, 12 minutes break. And then I think we come back to the two adjustments with you. So most of them is step number 6A, or 2A, and step number 7. And once in step 6, yes, most of them is step 2A and 7. And yes, one of them is, of course, the step number 6. But wait for more adjustments. You'll see the hit on the other steps also very soon. Right. So I think let's give you a break, friends, and then we start back again. So let's take a break. Okay, thank you. also could make a little revision in terms of the three adjustments we've discussed so far. Now let's come to the next adjustment, which is a little complicated one, and that deals with the impairment of goodwill. And I think before we discuss the goodwill impairment, you would also like to connect that when we look at the concept of goodwill impairment, in those cases, it can be a partial goodwill or it can be a case of a full goodwill. And accordingly, if there is a goodwill impairment, whether it's a full or a partial goodwill, accordingly, the things will be handled. So let's, I think, take the journey forward. Let's discuss the adjustment number 4. The adjustment number 4 is with reference to goodwill impairment. So I think we will segregate our discussions in terms of two parts. One is if it is a full goodwill, then what? And if it is a partial goodwill, then what? Just like the stock reserve we segregated in terms of down and upstream, the goodwill impairment is to be seen in terms of full or partial in nature. So let's divide this in two different parts. So if you've calculated a full goodwill, and there is impairment, or if you've calculated a partial goodwill and there is an impairment. By the way, let me also connect you that when do you get a full goodwill and when do you get a partial goodwill? When the NCI is at fair value, you get a full goodwill. And when the NCI is at PASNA, you get a partial goodwill. So everything depends upon the NCI. So when you take the NCI at a fair value, you get a full goodwill. And when you take the NCI at PASNA, in this particular case, we get the partial goodwill. I think you would remember the discussions which we did in Index 103, and I made it very clear that if the goodwill is full, it's borne by the parent and the NCI both. And if the goodwill is supposed to be partial, then it is borne only by the parent company itself. So your focus is now going to be on the step which pertains to goodwill, NCI, as well as the calculations of other equity. So I'm focusing in terms of step number 4, step number 5, and step number 6. So let's focus our inputs in terms of 3 steps. I think let me rather take some figures also to get it very clear. So let's say we're focusing in terms of step number 4, which is NCI. We're focusing in terms of step number 5, which is goodwill. And we're focusing in terms of step number 6, which is calculating the other equity in the consolidated balance sheet. Let's assume some arbitrary figures to get it clear. Let's say in this case, the impairment of goodwill. Let's consider is to the extent of, let's say, 20,000. And let's assume that the parent is got in the subsidiary 80%. And let's assume in this case, the impairment of goodwill is, let's say, 16,000. So let's consider the goodwill impairment is 20 and let's consider the goodwill impairment is 16. The parent has got an 80% stake. Now, let's see this carefully. So when you calculate the NCI, it is a full goodwill. NCI will bear 20%. So we'll reduce 4,000 from NCI. Because NCI will bear the amount of impairment share. So out of 20,000, 20% borne by the NCI. Now remember, when you calculate the new goodwill, you need to reduce the entire amount of goodwill. Because goodwill, we need a revised value. So whatever is the impairment amount is going to be entirely reduced. And the parent will bear his own share, that is 80%. So we can see 20% borne by the NCI, 80% borne by the parent, and the revised goodwill is after reducing the 20. Makes sense. Now let's come to the concept of partial goodwill. In case of partial goodwill, NCI will bear nothing. So we will reduce that 16,000, the entire impairment from goodwill, and you will reduce that entire 16,000 from the parent itself. because NCI is not going to bear anything in this case. So we just clearly put this not borne by NCI. It's not borne by NCI. It is 100% borne by parent. It is 100% borne by the holding company, or we can say the parent company. I hope, friends, I stand very clear on the goodwill impact as well, right? Got the inputs, the permutation combinations. If it is full goodwill, I can say step number 4, 5, 6. If it is partial goodwill, step number 5 and 6 only. Got the points, I guess. So that was adjustment number 4, that is goodwill impairment. Next. Then I'm coming to the last adjustment. That is adjustment number 5. Then I'm coming to the last adjustment, adjustment number 5. And the adjustment number 5 is with reference to, I would say, omissions. This is with reference to, I would say, omissions. Now, what are omissions? For example, there is a certain form of purchase consideration, and the parent company forgot to record that purchase consideration. Let's say there was a contingent consideration, or let's say there was a deferred consideration, and somehow the parent company forgot to capture the PC in terms of CC and DC. Mainly in terms of omissions, what you will get omissions related to PC. You will get omissions related to the purchase consideration. The parent company forgets to record the CC or the DC. Now watch this carefully, because what I'm about to give you has also come in one of the questions in the exam. So we need to be very clear that if there are any kind of omissions, what we're going to do. At the first instance, if you see omissions, do not consider them in any of the steps. If there is any omissions, you need to make an extract balance sheet before you proceed with the 7-step model. You heard me correct. If you see any omissions in the questions, do not proceed with the 7-step model. You need to take care of all those omissions in the extract balance sheet. So what we're going to do? If there are going to be omissions, we will first of all prepare an extract balance sheet. Before we proceed with the consolidation process, we will say, okay, let me make an extract balance sheet. Let me incorporate the changes. Had I knew that this omission had not occurred, then how my balance sheet would have seen. Now, let's, I think, consider two cases. Let's say if there is omission of a DC, or let's say there is an omission of a CC, how would you record this in the extract balance sheet? Let's consider two cases now. Let's consider two cases now. Let's consider there is an omission of DC. So let's consider there is an omission of a deferred consideration, or let's say there is an omission of a contingent consideration, which of course is paid in the shareholder's capacity. So we're linking the same concept which we did in Index 103. Now you need to connect the dots, that what were the entries you would have done on acquisition date and what are the entries which are done in a subsequent accounting. So let me ask you, if you omitted to record a deferred consideration on the date of acquisition, can I say what should be the entry? The entry should be investment debit and deferred consideration gets a credit, which is equal to the present value of the future payments. And would you like to remind me, what are you going to do subsequently?
Unwinding.
Very good. If there is a DC, you need to go for unwinding as well. So in the subsequent period, so we can say subsequently, we need to go for unwinding of discount. We need to go for unwinding of discount, and that is UOD. So the entry for that would be finance charge gets a debit and deferred consideration gets a credit. So you need to pass these entries and then prepare an extract balance sheet in this case. Great. Now let's say there is a contingent consideration. So you would have done the entry investment gets a debit and the contingent consideration gets a credit at a fair value. And would you like to remind me, what would you do subsequently if there is an omission of a CC? We did that earlier as well. If there is an omission of a CC, can you say the CC could be equity or financial liability? If it is equity, no subsequent accounting. If it is a financial liability, it's measured at FPTPL. Fair value changes in the PL, correct? So subsequently, you would classify this as equity instrument. If it is equity instrument, nothing is done. But if it is a financial liability, it is measured at FPTPL. And in which particular cases you can say the fair value changes will be captured in the profit and loss in that case. So if you see any omissions related to the purchase consideration, be careful. Do not take them in the 7-step model. Before the 7-step model, you need to make an extract balance sheet. Look at the entries which would have been done till balance sheet date, incorporate them in the balance sheet. So all these entries will be incorporated in the extract balance sheet, and then you proceed. So omissions would mean extract balance sheet, no change on the steps. Okay. So I think let me now consolidate the picture before we go further. I'm just going to map the mind, a little summary chart to get all the adjustments clear. So I've given you a total of 5 adjustments. I just want to, connect the dots. Which adjustment is going to hit which step? That's it. So let's make a summary chart. So we're looking at the adjustments and we're looking at the steps in which I will take care of this. So I think let me start asking, and you can start vouching me on this. If there is an intercompany owings, which step will you take care?
7.
Wonderful indeed. And can I say, does not make a difference, it is down or upstream. Intercompany owings, the concept of down and up is irrelevant. Great. Let's now consider stock reserve if it is downstream and if it is upstream. If it is downstream,
6 and 7.
very good. Step number 6 and step number 7. And upstream,
2A and 7.
very good. Step number 2A and step number 7. Then we did the third one, that is fair value adjustments. So where would I take care of the fair value adjustments?
2A and 7.
Wonderful. It will be step number 2A, and that will be in the pre and post acquisition column both, and the step number 7. And can I say here it will be in the post acquisition column just for reference. Next, let's consider step number, the adjustment number 4, and that is goodwill impairment. And goodwill impairment depends, it is full or partial. So if it is full, then, and if it is partial, then. So if it is full, step number?
Step number 5 and 6.
Full will be
4,
4
5,
and
6.
6. Yes, and partial will be 5 and 6.
5 and 6.
And then finally, I gave you that if there is any kind of omissions, then
No.
yes, no steps, but we'll make the inputs in the extract balance sheet in that case. You know what is now got to be done, which I'll not do at this stage. I'll do it in the next session with you when I make a summary chart. I will give you all the 7 steps, rewrite them, and tell you all the focus points which you need to take care in each step. So what I'll do, I'll tell you that in step 1 to step number 7, what are all the crucial points to be taken care. That's going to give you a complete mind map in terms of whatever is done in all those 7 steps put together. That would be the summary chart in the next session at the beginning. Okay, so far so good. Now I think we're ready to go to a comprehensive question. We'll, I think, go to a decent little question, not a very easy one as well, but something which is a little pretty decent one indeed.
So adjustment of dividend is also not.
Yes, I'm going to do that in the question right now because dividend adjustment is a little tricky one. So that's what I'm going to do right now. So I'm going to the study material and we're going to do a question which is given on test your understanding. I'll just zoom this across to you. There are 2 questions pertaining to the concept of dividends. So first, let's take a simple one where there is no NCI. Then maybe we can complicate it further. I hope, friends, it's visible to you. You can see that, right? Okay, now let's read. This is a question on test your understanding. I guess it is in unit number 8, which is given in the back of the questions. So I'm picking this from the study material itself. It says DEF acquired 100% ordinary shares of XYZ, and that is on 1st October X1. On 31st March X2, the summarized balance sheet is given. So quickly, if you look at the inputs, which case is this? Is it a consolidation on acquisition date or later date? And that's right, we said
Later.
It is at a later date because the acquisition is in the middle of the year and the balance sheet is made later. So there will be step number 2A and step number 2B. Let's read further. After the balance sheet, it says the retained earnings of XYZ shows a credit balance on 1st April, out of which a 10% dividend is paid on 1st November. I think that's what you're asking for, that what happens when there is a dividend payment, correct? I intentionally did not take it as a part of my adjustment discussions. Great. Then he says, out of which a 10% dividend is paid, DEF recognized the dividends to P&L, which is perfectly fine because that's an income for the parent. The fair value of the machinery is given and the depreciation rates are given. And following are the increases on comparison of fair value with the book values on 1st October. So these are all adjustments which can be called as fair value adjustments. So which step are you going to consider all these fair value adjustments? The machinery, the payables, the land, and the inventory. Step number
2A and 7.
2A.
That's right. Step number 2A and 7. It may be assumed that the inventory is still unsold on the balance sheet date. That means the inventory was taken at a fair value and it is still unsold, and the trade payable are also not yet settled. Also assume that the other reserves of both the companies on March X2 and 1st April is same. The reserves at the end of the year and reserves at the beginning of the year is equal. Or fair value adjustments have not yet started impacting the consolidated post-acquisition profits. We are required to make a consolidated balance sheet. I think you can notice that in this question, there is only a fair value adjustments and there is something new, which is on account of dividends. The fair value adjustments we know will take care in step number 2A and in terms of step number 7. But what about dividends? We'll make a walkthrough when we start. So let's begin the journey. Let's apply the 7-step model to TYU4. So let's, apply the 7-step model. This is test your understanding. That is 4. Now, as we do the steps, please concentrate on the given inputs in that step only. So let's go with the step number 1, which is getting the date of acquisition and the percentage. So we need to see the percentage and the date of acquisition. I think the percentage is 100%. And I think the date of acquisition is middle of the year. That's right. 1st October X1, that is the date of acquisition. So there is no challenge in terms of step number 1. I think that's always simple and straight, getting the percentage and getting the date of acquisition. Now we know the type of question already at the back of the mind. So we know that we need to take care of 2 things, step number 2A and step number 2B. Step number 2A would be analysis and step number 2B will be net assets. So let's make a chart for the analysis of other equity as we did earlier. So we'll take a column for particulars and we'll get pre and post. I think let's extend this also. So let's consider the column for pre as well as post acquisition. So we take this as particulars. We take this as pre-acquisition and we take this as post-acquisition. And it is always good to define in terms of dates what is pre and post. So you know the date of acquisition is 1st October. So we'll take this as pre-1st October X1. Anything from the date of acquisition 1st October X1 till the balance sheet date, which is March X2, which is 31st March X2. So it's always good to define the pre and the post acquisition in terms of date, that this is pre-acquisition date, anything from the acquisition date to the balance sheet date. Now, let me say a few things now at this stage. When you do the step number 2A, I would say there are a total of 3 focus points. Don't worry, we'll pen this down later in the next session when I'm going to make some summary charts at the very beginning. But you need to be clear that when you take your step number 2A, there are a total of 3 focus points. Number 1, you need to look into the other equity of the subsidiary's balance sheet. Your focus 1 will be to see the balance sheet of the subsidiary other equity analysis. The second focus point is to look at the additional information if there is any stock reserve which is upstream in nature, because that will also be taken here. And the focus number 3 is in terms of additional information again, that is fair value adjustments. So when you look at a step number 2A, your mind should tune that there are 3 focus points to be taken care of, considering all the kinds of adjustments. You need to consider the other equity of the subsidiary. You need to consider the stock reserve, which is upstream, and you need to consider the fair value adjustments in the additional information. In this case, I'm not given any stock reserve, but there are definitely fair value adjustments. So let's do one thing. Let's go back to the balance sheet of the subsidiary. Now, if you look at the balance sheet of the subsidiary company, so we can see that these are the reserves and the retained earnings which is appearing as a part of the other equity in the balance sheet. Now let's go to the additional information. He says the retained earnings add a credit balance of 3 lakhs on 1st April X1, out of which a dividend of 10% is paid on 1st November. So this is the balance at the beginning of the year, out of which we paid a dividends. And that's it. We are not given anything on reserves here. Reserves we are given out here in point 2. Other reserves of both the companies on March X2 and on 1st April is same. So this reserves on beginning and at the end of the year is same. So let's begin the journey with other reserves. Let's begin the input in terms of other reserves. First, make your timeline. As I said earlier, first make your timeline. So this is at the beginning of the year, 1st April, and this is at the end of the year. So what was the other reserves at the end of the year? It is, I guess, 10 lakh.
10 lakhs.
Correct. And the reserves, it says at the beginning, is also 10 lakh. So can I comfortably say that everything is pre-acquisition? There is no movement during the year?
Yes, sir.
So that takes care of the analysis of the other reserve. Then we go on to the retained earnings. Then we go on to the retained earnings. Again, consider a timeline. Again, consider a timeline. So on 1st April and on 31st March, I think the position of RE is 8.2 and the position of RE at the beginning is 3 lakh. That's what the RE is given. So the balance sheet is appearing at 8.2 and the additional information, the balance is 3 lakh. Now, it says the retained earnings was 3 lakh, but out of this, you paid a 10% dividend. So is this 3 lakh still available? No. When the subsidiary paid a 10% dividend on the share capital, this amount is not available. So we can see the equity share capital is 20 lakhs. So they paid a 10% dividend, that is 2 lakh. So what is still available is 1 lakh. Let me also ask you something. Is this 8.2 lakhs after subtracting 2 lakhs?
Yes,
Is
sir.
this after reducing 2 lakh? Yes.
Yes, sir.
This is after dividend. This is after dividend. The comparability rises. So when you look at a dividends, we will simply reduce the dividends to see that what is still available. I think we can now comfortably say that 1 lakh is pre. And now be careful. This increase of 7.2 is not in the post-acquisition period because my date of acquisition is in the middle of the year. So can I say this increase will be divided in the time ratio because your date of acquisition is in the middle of the year. So this increase of 7.2 lakhs will be divided between the pre and post in the time ratio. So this stands divided in the time ratio. I hope we stand clear at this stage, correct?
Yes, sir. Sir, dividend, if paid before date of acquisitions, then still treatment is same.
But you mean to say that this balance is given on 1st April only, not on the date of acquisition? Yes, absolutely.
So the dividend is paid on November in this question.
But we are sitting on 31st March X2. So it is paid on 1st November X1. So by the time we are sitting on the balance sheet date, this 8.2 lakhs is after dividend, right? So when you are segregating the pre and post, then this 8.2 cannot include 3. This 8.2 has to include only 1 lakh, right?
Yes, sir.
Yes.
Okay. Now let's come to the concept of the fair value adjustments. Let's come back. Now it says the fair value of the plant and machinery on 1st October X1 is given. Now we're given the fair value on the middle of the year. And the depreciation rate is 10%. Now this involves preparing a small little working note. When I look at the fair value of the machinery, that is plant and machinery, I think we need to carefully first organize the data. You made a fair valuation in the middle of the year, so we need to be very careful that what is the profit loss on the middle of the year. So let's first go back to the balance sheet and see. The plant and machinery at the end of the year is 1350. So we're given that the book value on 31st March X2 is supposed to be 13.5 lakhs. It says depreciation is at the rate of 10%. If depreciation is at the rate of 10%, assuming WDV, is this 13.5 representing 90%? Yes.
Yes, sir.
So I can gross it up and get the book value at the beginning of the year, that is 1st April X1. So gross it up, and I think this comes to 15 lakhs. Now, why did I do the grossing up to calculate the book value at the beginning of the year? Because I need to get the book value in the middle of the year because the acquisition date is middle of the year. So we need to get what is the fair value gain or loss. So what we'll do, we will now reduce the depreciation for a period of 6 months. So 1,50,000 is the depreciation for the entire year. So we can say 6 months is going to be 75,000, right? So
Yes,
this
sir.
works out at 1425. Is this the book value on the date of acquisition, that is 1st October X1? Yes. So we did a little backward calculations, first grossing up and getting the book value at the beginning and then getting the book value in the middle of the year. And this is revalued. The fair value of this on this particular date is 20 lakhs. So what is the fair value increase? Can I say 5,75,000?
Yes, sir.
Is this going to be pre or is this post?
Pre.
Yes. So we're going to fit this out here. So plant and machinery, the fair value gain is 575, for which I've already made a working note already. But there is something else which needs to be taken care at this stage. Can I say if you revalue this plant and machinery, there is going to be an additional depreciation as well, but only in the post-acquisition period, so for 6 months. Let's take care of the additional depreciation. So let's consider on this 575 a depreciation at the rate of 10%, 6 months. Is it 28,750?
Yes, sir.
But we will not consider this figure. We will not consider this figure. We will calculate a depreciation in another manner. Now watch this carefully. How? Let me ask you something based on the data given. Your financial year is April to 31st March. And the date of acquisition is 1st October. What is the value on which depreciation would have been taken for the first 6 months? Is it supposed to be 15 lakhs or 20 lakhs?
15 lakhs.
That's right. And what is the value on which the depreciation would have been taken for the remaining 6 months? 15 lakh or 20 lakhs?
20 lakhs.
That's right. So which means the company took a depreciation on 15, but they should have taken a depreciation on 20. So when you take your additional depreciation, we will consider the additional depreciation on the difference of 5 lakh at the rate of 10% for 6 months. I hope you got the point. So do not take the fair value gain and take an additional depreciation, but visualize that what is the figure on which depreciation was taken. It was taken on 15 lakhs. But what is the figure on which it should have been taken? That is 20 lakh. So the difference of 5 lakhs, we're going to consider a 10% depreciation 6 months. I think that works out at 25,000, right? So this is going to be fitted out here in the analysis. So my additional depreciation is going to be 25,000. Okay. So I think the fair value of the plant is done, but I think we're given some more fair value changes as well. Let's go back. It says the following are the increases of fair value with the book value on 1st October. Trades payable 1 lakh up. So if your trade payables goes up, is it a gain or loss?
Loss.
Loss, because the liability has gone up. The land and building increased by 10 lakh, that's a gain. So land and building, 10 lakhs gain. And inventory is again an asset that goes up, it's a gain. And inventory is 1,50,000. But the only issue is I am not given any depreciation rate on land and building. So in the absence of a depreciation rate, I will not be able to consider any depreciations on land and building because I'm not given the data. So we've just taken the fair value changes. That's it. I think that's it. Everything else is done in step number 2A. We'll just take the total of the pre-acquisition. I don't have space below. So I'm taking the total on the top line. So this is 10 lakh. plus 1 lakh plus 360, 575 minus 1. I think this is coming to 30 lakh 85,000, is it? And this is, I guess, 335. Just see, is the total correct? Post is correct. Just see the pre-acquisition is correct. This is 20.5, 4.6, 5.75. Yes, I think it is correct. Great. So this gives me the step number 2A, which is getting the pre and the post acquisition figures. I hope so far so good. Clear with the position, right? Now let's go further. Now we are on step number 2B. Now we need to be careful. I'll tell you what. Step number 2B is getting the net assets at date of acquisition. And we've already seen that this is going to be the sum total of equity share capital plus the other equity, which is pre-acquisition in nature. Now, friends, my advice in terms of step number 2B, because of dividend, hear me carefully. This might be confusing, but just hear me carefully. I'll just like to give you some good analysis at this stage. My focus is now turning on NCI, which you're going to calculate in step number 4. And my focus is on the goodwill, which you're going to calculate in step number 5. I'm now considering the NCI and the goodwill, and I want to get my understanding very clear. Now, please watch this. When you consider the goodwill, is this goodwill calculated on acquisition date or on the balance sheet date? Let's first get this very clear. Are you going to consider the goodwill on acquisition date, or are you going to consider on the balance sheet date?
Acquisition.
That's right. So this is going to be calculated on date of acquisition. And let me remind you, the date of acquisition is 1st October. Did I pay the dividends by that time? No. I did not pay the dividends by the time. The dividends were paid on 1st November. The dividends were paid on 1st November. So now watch this carefully. If it clicks in a second. So when you calculate a goodwill, you take the PC plus the NCI and you compare it with the net assets. Now tell me, according to you, should this net assets be after reducing the dividends or before reducing the dividends? I am calculating this on 1st October. The dividends were paid on 1st November. So are you going to consider the net assets before or after dividends?
Before.
Correct. So I need the net assets before dividend. And when you did the analysis of equity, you took the figure after dividends. So what we're going to do in step number 2B, very carefully organize the net assets before and after dividends. I hope the Goodwill Connect is very clear that you calculate this on the date of acquisition and the dividend is paid after that date. So we need the net assets before the dividend. Got my point?
Yes.
Great. Now let's see the other part. When you calculate the NCI, is this NCI on date of acquisition or on the balance sheet date? Consolidation.
Balance sheet.
Correct. This is on the consolidated balance sheet date. If it is on the consolidated balance sheet date, which means on 31st March, and the dividend is paid on 1st November. So what do you think in this particular case to calculate the NCI? If you want to calculate the NCI, you should take the net assets before or after the dividends.
After dividend.
Yes. Because if you're calculating the NCI after the date of acquisition, then we need to consider the net assets after dividend. So we need the figure after dividend. So moral of the story is that for the goodwill, you need net assets without dividend because we need the net assets on acquisition date. For NCI, we need the net assets after dividend because we need on the balance sheet date. Does this mean that we need two net assets for two different purposes? Yes. So I would advise when you go to the step number 2B, net assets, organize two net assets for yourself. I hope the position is very clear. So let's do one thing. Let's organize the net assets on two different manners. I want to look at the net assets. One is before reducing dividend, and one is the status which is after reducing dividend. So whenever dividend adjustments are given in the question, it would be good that you organize your step number 2B in terms of two data, net assets before and net assets after dividends. So let's begin the picture. So we take the equity share capital and the other equity, which is pre-acquisition in nature. Now remember, the analysis which you have done is after dividends. The analysis which you've done in step number 2A is already after dividends. So let's go back. So what was my equity share capital? That's appearing at 20 lakhs. And this is 30 lakh 85,000. So this is appearing at 20 lakhs. This is common. And can I say this is 30 lakh 85,000? So would you like to tell me what will be the figure without reducing dividend? I think we reduce the dividends to the extent of 2 lakhs, right?
32.
So just add another 2 lakhs. This comes to 32 lakh 85,000. So this is going to be 50 lakh 85,000. And this is going to be 52 lakh 85,000. So this is how we're going to organize our inputs in terms of step number 2B. I hope, friends, I stand absolutely clear. Because dividend is one thing which disturbs a lot of people. And since we need to be focused clear that for NCI, which net assets, for Goodwill, which net assets, so it is good to organize two net assets in step number 2B before and after dividends. Got the point?
Sir, dividend is paid before date of acquisition. That net asset at date of acquisition only consider after dividend, right?
Yes. Let's say, for example, your date of acquisition in this given example was post 1st November. Then I'm safe. Then for NCI as well as Goodwill, we need net assets after dividend only. Because in that particular case, dividend was already paid before.
But sir, step number 2A is impacted.
No, but if you acquired the shares, let's say on 1st of December, at that time the dividend was already paid. So for Goodwill, you need net assets before or after dividends. Let's put that question to you. After, right?
After.
So which means if the question wants to create a complications to you, you will notice the dividend is going to be paid after acquisition date. If the dividend is paid after the acquisition date, so net assets for Goodwill is before dividends. And for NCI, it is after. But if you say you acquired the shares and dividend was already paid before that, so you never participated in that dividend, no? In that case, the dividend was paid by the subsidiary before you became the holder of that company. So you never got a dividend. So whether it is NCI or whether it is Goodwill, the net assets at that stage is post the dividend. Then I don't need to do all these complications in that case.
But sir,
Right.
pre-acquisition is effect, na? Pre-acquisition profit jo pre-acquisition.
No. Now I think you're recalling in terms of what you've done in intermediate in AS21. That funder does not apply out here. The concept of pre and post acquisition dividends, to make it very clear, in terms of Ind AS, there is no such distinction. As a parent company, if I receive dividends under Ind AS, I will directly take it to the P&L. I will never segregate that it is pre or post. In terms of AS21, when a parent company receives a dividend, he segregates that this is for the pre-acquisition or a post-acquisition period, and he credits the pre to investment and credits the post to the P&L. But in Ind AS, there is nothing of this sort. From the parent company's standalone point of view, when you receive a dividend, it is all taken to the P&L. The segregation of what is pre and post-acquisition is totally irrelevant under Ind AS.
Okay, sir. Thank you.
Great.
Got it.
You're welcome. Okay, so I think this takes care of the position in terms of step number 2B. Now let's go to the next one. That is step number 3. Okay, so let's go to the step number 3 now in this case. So step number 3 would be the calculation of the purchase consideration. And that is nothing but it is the investment appearing in the balance sheet. So I think we can comfortably go back to the balance sheet and see what is the investments. So investment is appearing at 34 lakh. So we can conveniently get the purchase consideration that is 34 lakhs. Then we go to the step number 4, which is the calculation of the NCI. Now, careful, watchful again. So in terms of NCI, the focus is on the balance sheet date. So we need net asset after or before dividend.
After dividend.
Yes. So I'll take the net assets on date of acquisition, which is after dividends. So we can go back to the step number 2A, 2B, get the net assets after dividend, 50,85,000. So I think in this case, there is no NCI, but I'm just making a mention. In this particular case, there is no NCI because 100% stake is held by the parent, but I'm just making it clear that I would have taken 50,85,000 out here into the share of NCI, right?
Yes,
This is
sir.
just to make the position clear, though there is no NCI in this case. Next, we go to the step number 5. In step number 5, we're going to calculate the goodwill or the capital reserve. So we take the PC and we take the NCI on date of acquisition and we compare this with the net assets on the date of acquisition to calculate the goodwill or capital reserve. Now, very careful. So for goodwill, you need net assets after or before dividends.
Before dividend.
And even the NCI on date of acquisition, are you going to pick this NCI from here? Never. That's the reason I drew this. When you take the NCI on date of acquisition, do not take this NCI from the previous step. Why? The NCI in step number 4 is based on net assets after dividend. And I need the NCI on date of acquisition, which is before dividend. So when there is a dividend in the question, you can even come to the practice of calculating 2 NCI. But you need not do that. That will be too complicated indeed. But remember that you should never take the NCI from the previous step. You should calculate the NCI from this particular calculation itself. Got my point? So I think this is 34 lakhs. That is the purchase consideration. There is no NCI. So if you want to calculate an NCI, let me just make a mention. We can compute NCI. We can compute NCI based on net assets without reducing dividend. Without reducing dividends. So we will not take the information of NCI from step 4. You can take this net assets itself. I think that was 52,85,000, if I rightly remember. Yes. So we get a capital reserve in this case. So let's take a capital reserve. So 34 minus 52, that's I think 1885. Right, so this takes care of the step number 5. Now we can go to the step number 6. So let's go to the step number 6. I'll pen down the thoughts after the end of this question. As far as dividend adjustment is concerned, that becomes my adjustment number 6. That if there are dividend adjustments, which steps, what do you need to do? So step 6, we need to do the consolidated balance sheet. We need to get the other equity. Now, when you consider the consolidated balance sheet, other equity, considering all kind of adjustments, I would say there are again three focus points. Sorry. In terms of the step number 2A, I gave you three focus points. Now, in terms of the step number 6 also, I'm giving you three focus points. One is you need to consider the post-acquisition profits, which will come from step number 2A. The second is we need to consider stock reserve, which is downstream. Because if you remember, in a downstream, we consider the impact in step 6. And the third focus point is in terms of goodwill impairment, which is irrespective, it is full or partial goodwill, we need to take care of the goodwill impairment here. So in terms of the step number 6, your focus point should be post-acquisition profits, goodwill impairment, and the stock reserve, which is downstream. In this case, there is no goodwill impairment, there is no stock reserve, so just one item to be seen. So let's go back to the balance sheet of the parent and let's see what are the items in the other equity. So we've got other reserves 24 lakhs and 572. So we'll make a columnar position. So we've got one is other reserves and one is RE. So there is other reserves and there is retained earnings. Other reserves are 24 lakhs. And what was the RE? That's 572. So this is 572. So this is the holding company's own other equity picked up from the balance sheet. Now we just need to add the share in post acquisition. So add the share in post acquisition that we can get from the step number 2A. So let's go back to the analysis. Step number 2A. This is 3,35,000. So can I say this is all retained earnings? 100% belongs to the parent company. And I think that's it. So we can also do one more thing. Actually, since you're getting a capital reserve, this can also be taken out here. So that other equity in the balance sheet is a consolidation of all the inputs put together. So let me take the capital reserve also. It was 1885. So we can get the sum total of the other equity in the balance sheet of the company. So this is going to be 24 lakhs and this is 18 lakh 85. And let's see the middle one as well. This is 572 plus 335, 907. And now there is something else which also to be taken care. Can you guess what?
Dividend.
Yes. The parent company received the dividend from the subsidiary, and it is clearly instructed in the question that this dividend was credited to the P&L. It says DEF recognized the dividends to the P&L. So the treatment is correct. But at the end of the day, can I say this is now something which is, a common income and you can say a payment by the subsidiary? Because you're receiving it from your own group company, it's not an income. You need to eliminate this because it's not a group income. So what we're going to do in this stage, another inputs to be taken care. So we will eliminate the dividends. So minus the dividends which stands credited out here, because we can say it is not an income. It is not an income from group point of view. It is not an income from the group point of view, because this is between the parent and the subsidiary. From the group point of view, it's not an income. So what was the amount of dividends? I guess 2 lakhs. So let's rectify this. This is going to be 7 lakhs 7. Now let's take the sum total of these three figures. So next time I'm going to consolidate all this picture very clear. This I think 4992, I guess.
Yes, sir.
Correct. So this is step number 6. Now finally we are in a position to go for a consolidated balance sheet, step number 7. If you go systematic step by step, trust me, there is never ever a problem. So finally, in terms of the step number 7, we're looking at the consolidated balance sheet, and for which I gave you, we're going to make columns. So one column for the parent, subsidiary, adjustments, and the consolidation. So holding company, subsidiary company, and we take adjustments and the total. So now we need to keep the focus clear. There are a couple of fair value adjustments to be taken as well. So let's, I think, start the journey. Let's take the fair value adjustments. I'm just keeping the question in front of me as well, just to get the data connected. So we've got the non-current assets. I guess the non-current assets is, there is a PPE. The PPE for the holding company, I think, is 15 lakhs. Subsidy is 18 lakhs. And I think there were some fair value adjustments for PPE, right? What was the fair value gain? In step number 2A, the fair value gain was, I think, to the extent of 575. So 5,75,000. And I think then there was additional depreciation, 25, correct? That was on the PPE. So let's take the sum total, 15 plus 18. That's, I think, 5830. No.
8.5.
38.5, right?
Yes.
Okay, then the next item is land and building. Land and building is appearing at 24 lakh, 13.5 lakhs. And there was a fair value increase in the building, that's 10 lakh. So this is coming to, I guess, 47.5, right?
Yes, sir.
So that works out at 47 lakh 50. So this is the PPE in the balance sheet. Next, we are given investments will not appear. Then we've got the current assets inventory. So inventory is appearing at 12 lakhs and 364. Then there is a fair value change in the inventory, which is yet unsold. And that is, I think, 1.5 lakhs.
17.14 lakhs.
That's right, 17 lakh 14,000. So this is on the current assets inventory. Next, we are given the trade receivables and cash. Trade receivables is, I think, 598. And it is 4 lakh. And there is no intercompany owings, nothing. So 998. No fair value changes also. Then cash is 145 and 80. That becomes 225. So this is, I guess, the asset side of the balance sheet.
11,537,000.
Sorry, can you come again?
11,537,000.
11,537,000. Okay, so that is the total of the balance sheet. Now let's come to the equity side. Equity share capital only for the parent company. And this is to the extent of, I guess, 50 lakhs. Then I think the other equity we can take from step number 6. That was, I guess, 4992. And there is no NCI, otherwise we would have taken the NCI also out here. Then I guess there is no non-current liabilities. We just given the bank OD. That's the current liabilities. So the bank OD is 8 lakhs, nothing for the subsidiary. So this appears at 8 lakhs. And then there is a trades payable. The trades payable is 471. and 174. And I think there is a fair value change. That's, I think, 1 lakh. So this works out at a total 7,45,000. So let's see, is the balance sheet agreed on this?
Yes, sir.
Wonderful indeed. So this is the total, comes to 115,37,000. Wow. So this is how the consolidated balance sheet gets prepared. Now, a quick inputs on the dividends highlights. I'm not documenting that, but I'll just like to give you quick highlights on the dividend aspect. How does the dividend impact? Though I'll take a complete summary view of all the adjustments at the beginning of the next class itself, but just to connect a few dots. So when you're given the information as far as dividends are concerned, so here I am definitely going with the fact that it is paid after date of acquisition. So now what are the key focus points which you need to consider? I would say one is the impact on step number 2A. One is the step number 4. One is the step number 5. And one is the step number 6. So I would say there are 4 crucial points in terms of dividends. In terms of step number 2A, not 2A, rather I would say 2B. In terms of step number 2B, can I say we should calculate 2 net assets? One is before dividends and one is after dividends. That is, I think, 1 focus points. Organize your net assets in 2 parts. One is the net assets which is without paying dividends and one is after paying dividends. Next, when you go to the step number 4, that is NCI, you need to consider the net assets after dividends. That is another key focus point. When you go to the step number 5, in this case, when you calculate the goodwill, you need the net assets before dividend. And that's the reason we have organized them on a separate basis. Because this net assets will help me in the NCI and the goodwill. And finally, in terms of step number 6, can I say we'll have to reduce the dividend received by holding company because it's not an income from the group point of view. So this is how the dividends will be tackled. If you want, you can call it as adjustment number 6 in this case. Wow, so I think all the adjustments are taken care. So now we know the intercompany owings, the stock reserve, the goodwill impairment, the fair value adjustments, the omissions, and the dividends. So next session, what we'll do, we'll first make a quick summary outlining under each step what are the various issues to be kept in mind. Then we'll do comprehensive questions further. So totally devoted to the practical area. So next class, we'll be doing, complete comprehensive questions, doing the consolidation process. You want me to do the consolidation process on the Excel sheet, or you want me to do it on the board itself? You got a choice.
Yes, sir. Board is
Board is
comfort.
better. Okay. I think somebody said Excel.
I
I
have
think board is
one
preferable.
doubt also. So
Yeah, please go ahead.
step 2A, analysis of other equity, is always given figure after dividend, right, sir?
Yes. Step 2A will always be after dividend. I would not prefer to get my net assets, the analysis of equity before dividend. It is better to get it after. Then you can segregate before and after and 2B instead of 2A. Correct. Right, friends. So I think that brings us to the end of the inputs today. So we're going to see you with the practical illustrations in the next class with you. So that's all for the day. Thank you very much and wish you once again a very happy new year and see you in the next class with some more interesting agendas coming in. Thank you very much once again. Bye-bye.
Thank you, sir. Happy New Year, sir.
Thank you. Thank you, sir.
Thank you. Same to you. Hanji, thank you, Ji.